In a recent trading session, 3 different markets moved in a highly coordinated sequence. Bond yields shifted sharply, the US dollar cracked a key technical level, and precious metals reacted instantly. This is not random market noise. When these massive pools of global capital reposition in the exact same direction at the exact same moment, it leaves a distinct structural footprint. In 40 years of watching these markets, a shift of this magnitude has only appeared a handful of times. Yet the aftermath of this signal is almost always the same. As the mechanical response ripples through the system, metal prices frequently pull back. Everyday investors look at the red in their portfolios, assume a bull market is broken, and sell out of fear. Meanwhile, the mainstream financial press misses the mechanism entirely. They spend their broadcast time analyzing daily geopolitical events or isolated central bank comments, completely ignoring the massive structural forces moving underneath the surface. Ignoring the daily headlines to focus on these underlying mechanical signals allows for a clearer view of what institutional capital is doing before the public catches on. To see how this works, we have to look at the financial physics governing gold and silver. Their daily price action is dictated by 2 heavy downward forces, the US dollar and the 10-year Treasury yield. This diagram illustrates the inverse relationship between the US dollar and commodities. Because gold and silver are priced in dollars, a rising dollar makes those metals mathematically more expensive for foreign buyers. Demand is crushed and prices are forced down. Now we add the bond market to the equation. When government yields spike, institutional wealth has a mathematical incentive to hold bonds that pay a return. The opportunity cost of holding non-yielding assets like gold becomes too high, acting as a second compressing weight on the price. We have seen this specific mechanical suppression play out before. During the energy and inflation crisis of the 1970s, yields stayed elevated and the dollar surged. Gold pulled back hard, shaking out casual investors. The same sequence triggered in the early 1990s. Geopolitical shocks drove oil prices up, and as yields and the dollar reasserted themselves, metal prices took an identical initial hit. In 2008, a systemic panic forced heavy liquidations across every asset class. Institutions scrambled to raise cash to cover margin calls, dragging gold down with the broader market and convincing observers it had failed as a safe haven. And in 2022, as central banks executed a rapid series of rate hikes to fight inflation, yields spiked and the dollar reached multi-decade highs, severely suppressing the metals market once again. Across 5 decades and entirely different economic triggers, the rule holds. The mechanical suppression eventually exhausts itself. The headwinds break, and the underlying pressure forces gold and silver into record-breaking rallies, entirely leaving behind the retail sellers who panicked during the dip. But the cycle we are entering now is carrying a much heavier load. Today, the national debt is compounding past $39 trillion. The interest expense alone is consuming a share of the federal budget that dwarfs any fiscal constraint from past crises. Notice what is happening on this chart. Central banks are accumulating gold at a record-breaking pace, a move that signals a strategic repositioning of their reserves away from the traditional Western system. Then there is silver, which faces a structural condition that simply did not exist in the 70s, 90s, or 2000s, a massive, unfixable supply deficit. The modern economy is consuming silver far faster than it can be pulled from the ground. Massive solar farm infrastructure, electric vehicle manufacturing, and the data centers powering artificial intelligence all require heavy amounts of silver with no viable commercial substitute. The mining industry cannot easily respond to this demand. The vast majority of silver is mined only as a byproduct of copper, lead, and zinc. A rising silver price does not magically flip a switch to increase production. This chart maps what we call the cyclical blueprint. When you combine extreme macro pressures with the recent market signal, it triggers a rigid 4-phase sequence. Phase 1 is panic, Phase 2 is absorption, Phase 3 is the structural bid, and Phase 4 brings all-time highs. We are focusing right here on the first half of the timeline. Phase 1 is characterized by erratic price swings and emotional reactions. Phase 2 is the quiet, painful pullback, where the initial panic subsides, but prices drift sideways or downward. Historically, once the mechanical headwinds of the first 2 phases exhaust themselves, the underlying supply deficits and fiscal pressures have consistently cleared the path for a move toward new highs. The recent coordinated shifts in yields and currencies mirror the behavior seen in past cycles, as the market moves away from the initial panic of phase 1 and begins the absorption phase. This absorption phase is the most dangerous period for individual portfolios. It is the period where impatience causes people to lock in a permanent loss right before the actual bottom is established. This frustration is especially potent with silver. Historically, silver lags early in this cycle. It moves sideways or even drifts lower while gold starts its recovery, punishing investors who lack the patience to wait out the mechanics. But history also shows that once the monetary investment logic catches up to the raw industrial demand, silver does not merely follow gold. It acts like a second engine igniting, frequently multiplying gold's percentage gains by a massive factor. So the mandate right now is simple. Do not panic buy and do not panic sell into the dips. To survive this phase, you must focus your attention on two highly specific data points. First metric, the US dollar indexed. Breaking below its technical range signals the headwind suppressing metals is lifting. Next is the 10-year Treasury yield. As it falls, the opportunity cost evaporates, forcing institutional wealth back into hard assets, creating the structural bid. Watching these two numbers provides the only reliable map through the volatility. Identifying the end of the suppression phase allows you to ignore the headlines and remain positioned for the eventual shift in the trend.